Hey, if you're thinking about buying or selling your home this spring, doesn't it feel like lately you're in a tsunami or you're trying to surf the wave of interest rates, wondering when is the right time to exactly buy or sell? Well, let's look at what's happening in the first quarter and what adjustments are being made across the board compared to what we were told was going to happen back in December of 2023, and how this information will help you prepare whether you're buying or selling a home this spring. Let's dive right in. No pun intended. You know, when we look at what's been happening the first quarter of 2024, the news looked pretty good in January and February. Listings in January were up 17.4% and pendings were up 4.6%. And in February, listings were up a whopping 21.7%, with pendings actually slightly down 0.3%. And then in March, listings actually went down 4%, but pendings were up a whopping 7.7%. And really, these numbers are reflective about what was going on with our winter real estate market, which tends to be a little bit slower this time of year. And rates were adjusting, but just a little bit. There wasn't the big interest rate drop that we were expecting per the dot plot map from back in December of 2023 that I reported on from the Fed. And we weren't seeing home prices decrease like the media kept telling us they would. Now, current changes to the Fed's original plan that I reported back in December are due to what's happening with the economy, and I'll get to that in a minute. What I really see with the increases in pending or under contracts in the first quarter is that buyers are getting comfortable or at least accepting a higher interest rate right now. And those that can buy are no longer waiting to make their move. In fact, millennials now officially our largest buying group. Those are all our people between 30 and 34 years old who want home ownership. We were all excited with January and February's increased listings because it gave the buyer more inventory to choose from. It also led to a little more concessions being given by the seller and some negotiating gone. Something we haven't seen in the last few years. But once again, the changes in how this inventory is trending in the first quarter of the year. In January, inventory was 9.7 weeks, and that was up 1 week from January of 2023. And in February, the inventory dropped to 7.4 weeks, and then in March it dropped to 7.3 weeks. Each one up 1 week before the year before. However, inventory is trending down from January's 9.7 weeks. Now, although this sounds like a lot of inventory based upon the fact that over the last few years, we've been dealing with like 1 week, 2 weeks worth of homes for sale. The reality is, in order for it to be a balanced market, we need 5 to 7 months supply of homes for sale. So this number of 7.3 weeks is still under 2 months, meaning we're in a seller's market. Due to the interest rates, which I'll discuss in a bit, it's not the crazy seller's market it's been over the last few years. However, your home looks good and it's priced correctly, you may be seeing get an offer or offers quickly due to the lack of inventory for sale. We see this reflected in 2 other market numbers that we tend to follow. One is days in the market. The number reflects how long are you on the market before you get a contract on the house. In January, the days on market were 36, in February it dropped to 24, and in March it dropped down to 12. Again, those buyers that can are buying, and they're doing it quickly, likely realizing that interest rates aren't going to go down anytime soon, and there isn't a lot of inventory to choose from. The second number is the median price. This is a number that's actually been trending up since the beginning of January, and of course, up year over year. In January, the median price was $564,990,000, and that was up from $535,000 of January of 2023. And in February, the median sale price was $575,000, up from $556,000. And in March, the median sale price was a whopping $591,015, up from $565,000 the year before. So where the media was reporting that home prices would come down due to these high interest rates, it's just not happening here in Denver metro area. This reflects the fact that your home's value, if you're a seller, is really what a buyer is willing to pay for your home and what you're willing to sell your home for. And a lot of that is going to be due to supply and demand, making 2024 so far a strong seller's market and a challenging market for home buyers. Now, let's take a look at the economy. January and February's listings were up and looked really nice, but then dropped to a negative 0.4% in March. And this could be because the Fed did not lower the Fed rate back on March 20th like we'd expected them to. In fact, if you look back at some of my previous videos, in December and January, we reported that everyone was waiting around for March 20th, thinking that was going to be the first of 3 Fed rate drops that Powell was going to do in 2024. In fact, some people got so excited that news outlets were reporting that there were going to be 6 rate drops, with the first one occurring again on March 20th. Now, when the Fed drops their rate, it's not tied to the mortgage interest rates, but many times it does influence them. Unfortunately, March 20th came and went this year, and there was no drop. In fact, there's now talk of interest rates being higher for longer. Now, this could be one of the reasons we saw listings drop to a negative 0.4% in March. Plus, new data came out that said 78% of baby boomers want to age in place, with 51% saying that they like where they live. Well, yeah, remember, a lot of them have interest rates way below what we have today, or they have no mortgage on their home at all. Along with this, we got some very interesting economic data that came in this past week. The biggest was CPI, or Consumer Price Index. This is one of the most widely followed inflation indicators. In February, CPI rose to 3.8%, and in March, CPI rose 3.5% year over year. This is the 10th month in a row, by the way, that CPI has been ranging between 3.1 and 3.7%, well above the Fed's 2% desired target rate. Now, Powell has maintained that he will not start cutting the Fed's short-term benchmark interest rate until CPI is substantially closer to that 2%. This has caused Lawrence Young, chief economist of the National Association of Realtors, to say, March inflation figures were very bad, which also means bad news for interest rates. So consumer spending encourages a strong GDP, which supports increased prices, increased wages, and ultimately increased inflation. Other economic news was unemployment. Unemployment has been hovering between 3.7 and 3.9%. In March, it dropped to 3.8%. And if you remember in December when I went through the dot plot map that the Fed had put together, the 3 rate decreases for 2024 were based on an unemployment rate of 4.1%. All of this basically means that interest rates are going to stay higher for a longer period, and that means buying a home right now is going to be more costly. However, the rates staying up longer may add some stability for those planning to buy because it allows them to really create a strategy around their home purchase. By the way, if you're an older homeowner, look, millennials need your house, and it might just be the time for you to right size for your lifestyle. Did you know that you could do that without a mortgage or payments? And that's called a reverse mortgage, and it's very different from the old one that you might remember. Reach out to me for a connection to a reverse mortgage expert. Hi, my name's Peggy Dursthoff with Live Denver Suburbs, powered by HomeSmart. And if you enjoyed this video and you are an older homeowner, please go ahead and check out this one over here where I talk about how to downsize into a smaller home. Thank you so much for watching, and I'll see you on the next video.